Hello, Business 202. This Google Hangout introduces you to Chapter 17, Financial Statement Analysis. You can see on your screen the outline for Chapter 17 that you can download from the class notes folder from G Drive. What I would like to do is to give you some context about how these ratios are used in business and where some of this information comes from. Secondly, what I would like to do is to review Nike's annual report. You can see that Nike is the cameo company for this chapter, so that you can recognize the required content for a corporate annual report. Before we do that, though, I would like to point out one thing that I have done for the course calendar. So let me share that screen with you. There, you should see the course calendar on your screens. And the items for Chapter 17 are already posted. But what you will notice when you punch up the course calendar is that there is now some bookmarks that will allow you to navigate the calendar a little bit easier. It is getting lengthy, and so what you would be able to do when you first see the screen is to click on the desired chapter that you want, and you will automatically be taken to that particular location. To get back up to the top of the course calendar, just click the Control Home key and you automatically go there. Okay, so that was the additional information about what's going on with the course calendar. Also, what I'd like to show you is that in Chapter 17, Financial Statement Analysis on Google Drive, there are three Google templates that you will use for this set of exercises. For exercise 225, exercise 17.2, exercise 17.4, and exercise 17.5. These will be very similar to what you have already done, and I'm looking for you to put in Excel formulas and functions where they are appropriate. Also, what you have in Chapter 17 is a Nike case study. And with this particular Nike case study, there are a series of ratios that are available, and oftentimes business people will use these ratios and sometimes even draw a chart of them so that they can very quickly see how the company is performing. Also, what you have is a download of some information from a company called Mergent Online. This is a financial services company that would take the financial information from a variety of financial statements that are published and put them into a standardized format that business people can use, and you can get up to 10 years of information about a company using this Mergent Online. In addition, what Mergent Online does is to create the common size financial statements and the growth rates that you see discussed in the beginning of the chapter. So oftentimes that information already is done for you. Okay, and I'm just pointing out that most of the financial services of which Bridgewater College has purchased that, and you can see that on the chapter outline, there is a link to the Alexander Mack Library. Just look at the databases and you can download this information for yourself. Okay, let's just take a quick look at the Nike annual report. And what I'm trying to do here is to show that there are three main features that you have in the report. This is called a 10K report, which represents the required financial information that all publicly traded companies must submit to the Securities and Exchange Commission at least once a year. A 10K report represents the annual report. A 10Q report would be a report that a company would show quarterly. Now, as your outlines would indicate, under Part 4, there are three items that are required of every annual report: the management discussion and analysis, a report on internal control, and the auditor's report on the financial statements themselves. Now, most of the annual reports that go to the SEC do have a table of contents like you see right here. And the annual report is a fairly lengthy document. The first item that your textbook mentions is the management discussion and analysis, and that's on page 23. So let's just take a look at that. What the management analysis and discussion of financial conditions do is just summarize why the company performed well in certain areas, what the challenges were of a particular company, and some of the assumptions that the company is using as it projects its budget and its financial statement going forward. And you can see just on the summary page here, some of the items that Nike is stating as the groundwork for the financial statements that you see. And the management discussion and analysis is a fairly lengthy and a fairly in-depth report of the assumptions and the framework that the company uses in preparing its financial statements and its financial forecasts. Every annual report is required to have one of those. The next item that you have on the required item is a report on internal control. And as you can see under item 9A, Nike has that, and that's on page 88. And so let's just jump down to page 88 for Nike's report on internal control. Okay, here on page 98, it says that management is responsible to disclose controls and maintain procedures that are designed to ensure information required to be disclosed in our Exchange Act, that's with the Securities and Exchange Act, is recorded, processed, summarized, and reported within the time period specified by the SEC rules. The main point that this outlines is that management is responsible for the internal control. This came about because of the Enron fiasco about a dozen years ago, and management is held criminally liable if the financial statements are false and misleading, and if there are not proper controls in place. Also, it's indicating to you, if we would go back to page 54 of the annual report, there is the formal report on internal control. And here you see that particular report that highlights that management is responsible for maintaining an adequate internal control over the financial reporting. It's signed by the Chief Executive Officer, and it is signed by the Chief Financial Officer, which indicates that they recognize that they could be held criminally liable if the financial statements are false and misleading. The third item that's required of the annual report is a report from the external auditor. In this case, that auditor is PricewaterhouseCoopers, one of the big four public accounting firms. Essentially, what this report says is that in the auditor's opinion, these financial statements, which would be the income statement, the balance sheet, the statement of owner's equity, and the cash flow statements, in all material respects, reflect what actually happened for this particular company. When Nike hires PricewaterhouseCoopers to do an audit, PricewaterhouseCoopers is not creating the financial statements. They are merely auditing the auditing the financial statements that Nike Corporation has presented. After that, excuse me, folks, I still get choked up when I talk about this stuff. Now, what's the purpose of this audit report? Its purpose is to attest to the fairness of the presentation of the financial statements. And why is that important? Because investors rely on these financial statements to make their decisions to buy and sell shares of Nike stock. And in a larger sense, it adds to the ability of capital markets, that is buying and selling initial public offerings on the New York Stock Exchange, for these companies to raise money as they need to. Without this verification, investors sense greater risk in trusting the financial statements, and where there is greater risk, there are lower stock prices. So this audit is very important in maintaining the stock prices of the United States financial markets. And fourth, that you have in the annual report are the financial statements themselves. And here you can see Nike financial statements. And for as large as the Nike company is, its income statement is rather condensed. And you can see that there are just a few captions here. The balance sheet, likewise, is fairly condensed, but it does show the sections of the balance sheet: the current assets and current liabilities, the plant, property, and equipment, long-term debt, and the owner's equity. Additionally, you have the statement of cash flows, which we just talked about in Chapter 16. And then we have a detailed analysis of the increases and decreases in shareholders' equity. The reason why this item is so detailed is because owners buy shares of stock and they are very interested in how their wealth might have increased or decreased during a particular period. Okay, now why was this long-winded preface added to this Hangout? Well, the information that the Chapter 17 is talking about for the ratios come directly from the financial statements that you see in these annual reports. And what companies like Mergent Online do is to collect this information. It's downloaded in digital form. It just happens to be known as XBRL format. That's an acronym for Extensible Business Reporting Language, so that companies like Mergent can download it, standardize it, and summarize it, and publish it to the investing public. Okay, now that we have that preliminary information out of the way, let's go back and take a look at what we want to do with the outline that we have for this particular chapter. So I'm going to share that screen with you again. And here you see the list of the various ratios that the textbook is going over with you. Again, the Cengage videos explain these in detail, and I will not repeat that here. What I do want to mention, though, is that I will not require you to memorize these, but what I would like you to recognize is how any of these ratios are interpreted. Essentially, what is a ratio? Well, it is a fraction. So let's take the current ratio as an example. The current ratio is a ratio of the balance sheet's current assets to the current liabilities. And any value that you would have for a ratio, let's say that you had a current position of 2 which means that there would be $2 of current assets for every $1 of current liabilities. A ratio is interpreted as the number of dollars of whatever is in the numerator for a single dollar of what is in the denominator. That's it. That's as straightforward as all the ratios are. Let's take a look at another ratio here. For example, the ratio of net sales to assets. So that would be a ratio of a company's sales to the company's total assets. And let's say a company had $5 million in sales and it had $2 million of total assets. When you would create this particular ratio, you would get a ratio of 2.5 to 1. You would interpret that as that this company would generate $2.50 in sales for every dollar of resources, assets that it owns. So this talks about the productivity of the assets. And just to bring the point home one more time, let's take a look at the rate of return on shareholders' equity. The rate of return on shareholders' equity essentially is the earnings available for common that we talked about in Chapter 14 divided by the CSE common shareholders' equity. So if the earnings available for common were $1 million and the common shareholders' equity would be $4 million, you would have a rate earned on common shareholders' equity of 0.25. To interpret that, you would put what is in the numerator, earnings available for common, and divide it by what is in the denominator, common shareholders' equity. In this case, for every dollar that the owners can claim on the company has earned for them 25%. Okay, so that is the general idea of how to interpret a ratio. Whatever is in the numerator is compared to $1 of whatever is in the denominator. Now, most of the ratios will be fairly straightforward, but I would like to embellish a couple of them. Businesses tend to use turnover ratios fairly frequently, and I would like to just give a little bit of context to the inventory analysis and the receivable analysis and what your textbook and what your Cengage videos talk about with turnovers. So what I'm going to do here is just to take some information from page 806. And if you'd want to stop this video and turn to page 806, which shows you the illustrative problem about the Rainbow Company, that might help you see some of this information. In the meantime, what we are doing, this is page 806. We want to see how inventories, which are $720,000 for 2014 for the Rainbow Company, and accounts receivable, which are $425,000 for the company, relate to its net sales, $5 million, and its cost of goods sold, $3.2 million. Okay, so here's the context. ITO represents the inventory turnover. So how is this going to be used? Inventory turnover, according to your textbook, is calculated by dividing the cost of goods sold for the current year by the average inventory. Now, why are these averages done? The income statement information is over a year. The balance sheet shows you a point in time. So if we take the beginning point and the end point, on average, we have the inventory that would have been outstanding. We don't want any particular point to sway the ratio any great deal, so we take an average. If you look at the financial statements on page 806, the cost of goods sold from the income statement for 2014 is $3.4 million. I am omitting the millions. And the cost of goods sold, the inventory from the balance sheet is $720,000 for 2014 and $480,000 for 2013. Divide that sum by 2, and you have average inventory of $600,000. So on average, $600,000 of inventory was outstanding. Now think about when we make a journal entry to show the sale of goods. Usually we would debit, increase cost of goods sold, and we would reduce credit inventory. So you can see, naturally, since cost of goods sold and inventory are part of a journal entry when a company makes a sale, these two items are naturals for analyzing for a ratio. So we have $3.4 million of cost of goods sold compared to $600,000 of inventory. That means that there would be $5.70 of cost of goods sold for every $1 of inventory, or the amount of cost of sales that we have is 5.7 times the size of inventory. And your thought would be, well, so what? Well, think about what inventory is. Inventory is an overhead item for a business. If a business would much rather have its way, it wouldn't have any inventory because it costs to store it, to protect it, to insure it, to make sure people don't walk away with it. It is a burden. And so businesses in general would want to hold the least amount of inventory to get the most sales possible. Okay, so the turnover represents how quickly this business can turn over its inventory to get the most of sales and minimize the cost of supporting that inventory. A secondary measure falls from the inventory turnover, and that is the DTS, days to sell. So, geez, let's look at it this way. How many days are there in a year? 365. And how many times does the inventory turn over? Well, it turns over 5.7 times a year, just under 6. And if we would take almost 6 and divide it into 365, well, 6 into 365, that's a year. And so that's like 2 months. So turning that into a number of days, 2 months is 30 times 2, 60 days. This Rainbow Paint Company takes on average 2 months to sell its inventory. So that means that this business is strapped with carrying and feeding its inventory for about 2 months before it can push it into the customer's hands. The shorter the time span, the better the company managers like it. Now, there's a second part to selling inventory. It's nice to sell, but it is even nicer to collect cash. So accounts receivable is very important. So let's take a look at an acronym that looks a little bit like it comes from Star Wars, ARTO. Accounts receivable turnover. That's also created by matching something from the income statement, sales, and dividing it by an average of something that comes from the balance sheet, in this case, accounts receivable. Why do these two make sense? Well, let's think of the sales journal entry again. When a company makes a sale, it would want to increase sales or credit sales, and it would also want to increase accounts receivable, debit accounts receivable, representing the amount that the customer owes the business. For the Rainbow Paint Company, if you would look at the 2014 income statement on page 806, you see that the sales would be net $5 million, And the accounts receivable for 2014 would be $425,000. For the previous year, $325,000. And when you divide that sum by 2, you get average inventory of 375, excuse me, the average accounts receivable of $375,000. Comparing sales to the average accounts receivable balance, that means that there would be $13.30 in sales for every $1 held on the balance sheet, or sales would be 13.3 times the size of accounts receivable. Okay, now let's make that into a ratio that really drives this home. That ratio is the DTC, the days to collect. So if we would take the number of days in a year and divide it by the accounts receivable turnover, in this case 365 divided by 13.3, there are 12 months in a year, so this is just a little bit quicker than once a month. That turns into 27.4 days. So what the days to collect says is that this company takes 27.4 days to collect its cash once it makes a sale. Okay, here comes the aha point to this whole session. A company is very concerned about when it spends cash and when it gets cash back in. So how long does it have to wait from the time it spends cash until the time cash comes in from customers? Well, let's take a look at this inventory cycle that we just described up here. When a company buys inventory, it has to pay cash to get it. And if inventory stays around about 64 days before it's sold, well, there is a lag of about 2 months that the business is without cash. And after the sale, the company has to wait another 27 days. And so that means that in total, the company is waiting 64 plus 27.4, or 91.4 days to get its cash. That's about 3 months. So what does that mean? The company better have lines of credit to carry it through this 3-month period while it waits for cash to come in after it buys the inventory. Okay, that's the aha point. If you would add the days to sell to the days to collect, you get the days without cash. The days without cash represent the number of days that the company must have lines of credit, short-term borrowing, on hand in order to pay its bills and employees during this period of time that it is waiting for cash. Okay? Okay, that is the discussion on the inventory turnover. And there is one more item that we would like to address, and that is the return on equity, the profitability of the company itself. And we will focus on this item, rate returned on shareholders' equity, which is calculated net income divided by shareholders' equity. Why is this important? Well, shareholders' equity represents the owner's claim on a business, and owners want to know how many dollars does the company earn for every dollar that they have put up to sponsor some cash for this particular company. Okay, so let's just put some of these things into context. And what we're addressing here is the company's earning power. This was developed over 100 years ago in the early 1900s by a company called DuPont de Nemours Corporation. It's a big Delaware chemical company, and they are still around and still making a lot of chemical sales. And what they recognized was that the return on equity, the profitability of owner's investment, really depends on 3 things that a company can do. One is to generate sales. If a company can't sell the products that it manufactures or buys for resale, it will not be in business very long. The second thing that a company can do is to maintain a strong brand image. That means a strong markup of selling price over its cost, plus it should control its operating expenses. And as we learned in chapter 14, being smart in the way it finances through debt. And we showed you that depending on profitability, sometimes borrowing more can increase a company's profitability. That is known as financial leverage. So a company's earning power depends on three things: sales generation, brand image and cost control, and financial leverage. Each of these can be expressed as ratios. Sales generation is known as expressed as the asset turnover. Brand image and cost control is expressed by the ratio net profit margin, and financial leverage compares how many dollars of assets can be supported by $1 of owner's investment in the company. And to break these out a little bit more, the asset turnover is this ratio, sales divided by assets. How many dollars of sales can $1 of assets generate? Now, we know we have sales. The second thing that we want to find out is how much net income each dollar of sales produces. And then finally, what is the bang for the buck in financing through debt? Okay, so let's operationalize some of these items. Now, you can do for yourself by looking on page 808 for the calculation of some of these particular ratios. And I will just summarize them right here. If you have any questions on the calculations, please send me an email and I will be sure to address them. But for the Rainbow Paint Company, we found that the asset turnover is 1.3. In other words, for every dollar of paint can make sales of $1.30. For each dollar of sales the company makes, it will generate income of 4.9 cents. So this tells you how profitable the sales dollars are. Now, how many dollars of assets can each dollar of owner's equity support? $2.04, which means that for every dollar that the owners contribute to the business by buying stock, they have $2.04 of assets working to get them profit, which is a good thing for the owners. Okay, now let's see how this rolls out. If we would calculate the return on equity, and the return on equity for the company is the net income divided by the owner's equity, we would find that that would be 13%. Now, here comes the aha moment with this DuPont formula. And go ahead and get your calculators, and let's see if we can see how this works. If we would multiply the asset turnover by the net profit margin by the financial leverage, we should get the return on equity. So 1.3 times 0.049 times 2.04, that in fact gets us very close to the 13% return on equity. Okay, now why do we do this? Well, what we want to do is to decompose or explain why owners get a 13-cent return for every dollar that they put up. And we explain it by saying that for every dollar of assets on the balance sheet, the company can generate $1.30 in sales. And for every dollar of sales, the company earns about a nickel in profit. That profitability is enhanced because the business financed some of the assets through debt instead of asking the owners to finance all of the assets. In other words, the owners can control $2.04 of assets for every dollar that they can contribute. And what business people do is to monitor the trend of these three items and compare it to the trend in return on equity so that they can explain what component of the business is driving return on equity up or driving return on equity down. Okay, folks, that is the context that I would like to add to Chapter 4 on ratios. And this will end this particular Hangout. Listen to the videos that are on the pardon me, course calendar, work the example exercises, and just as a reminder, these will be due at 11 o'clock Monday, July 9th. Have a good 4th of July, and we will talk to you next week.